This is silver. It's a metal that almost everyone knows about, but very few people truly understand. It's shiny, it's affordable compared to gold, and for decades it's been dismissed as poor man's gold, a secondary metal for people who can't quite afford the real thing. While the world watches gold, central banks have been buying it at record levels, accumulating over 1,000 tons per year since 2022. They treat gold as the ultimate store of value and the undisputed symbol of monetary power. Silver, by contrast, has been completely ignored by these same institutions. After all, why would a serious central bank buy an industrial metal when they could buy gold? Well, that conventional wisdom has held for over 70 years. But as we move through early 2026, something unintuitive is happening. The rules that have governed the precious metals market for generations are quietly being rewritten. For the first time since the Hunt brothers tried to corner the market in 1980, we're seeing signs that institutional players are moving into physical silver at a scale that could fundamentally alter global markets. And here is the part that should make you pay attention. The early movers aren't hedge funds. They aren't retail investors on Reddit. They are central banks, the very institutions that have spent decades pretending silver doesn't exist. To put this in perspective, silver just broke through $121 per ounce in February 2026. That is up from just $29 at the start of 2025. We are looking at a 317% increase in just over a year. For context, the last time silver moved this aggressively was during the inflationary chaos of 1979 to 1980, when prices surged alongside collapsing confidence in fiat currencies. But here's what makes this rally different and frankly more concerning. Back then it was speculative mania driving prices. This time it's something far more structural. The global silver market has been running consecutive deficits for 6 straight years. Inventories are collapsing. And now, governments are starting to treat silver like what it actually is, a strategic asset. The question isn't just what's happening with silver. The real questions are, why are central banks suddenly interested in a metal they've ignored for decades? What do they know that the market doesn't? And if institutions are quietly cornering the physical market, what does that mean for the rest of us? To understand what's happening with silver right now, we need to start with a reality that most people don't appreciate. Silver isn't mined like gold. It's not some romantic story of prospectors finding veins of pure metal in the mountains. The brutal truth is that roughly 70% of the world's silver comes as a byproduct of mining for other metals, primarily copper, zinc, and lead. This means that even if silver prices double or triple, miners can't just flip a switch and produce more silver. Their operations are driven by the economics of base metals, not silver's spot price. And what's more, global silver mine production has been essentially flat for years. In 2025, total mine output was only about 830 million ounces, barely 2% higher than the previous year. Meanwhile, demand has been running at approximately 1.24 billion ounces annually. That's a deficit of over 230 million ounces in 2025 alone, roughly equivalent to the entire annual output of Mexico, which happens to be the world's largest silver producer. And this isn't a one-year anomaly. The silver market has been in structural deficit every single year since 2021, with cumulative shortfalls estimated at somewhere between 820 million and 900 million ounces over that period. That's nearly an entire year's worth of global mine production that has simply been drained from above-ground inventories. Now you might think, well, if there's a deficit, prices should have been rising steadily for years. And you'd be right to expect that. But here's where things get interesting. For most of the early 2020s, those deficits were being papered over by drawing down inventories that had built up over decades. Silver stored in exchange warehouses, bank vaults, and private holdings was quietly being moved around to fill the gaps. The London Bullion Market Association, which is essentially the heart of global spot silver trading, reported eligible silver stocks of about 155 million ounces by late 2025. To put that in context, annual demand is running at over 1.2 billion ounces. That means LBMA's entire visible inventory would cover global demand for less than 2 months. And then there's an even more telling indicator that most people never hear about: lease rates. Silver leasing allows central banks and large institutions to lend out metal for a yield. In normal years with ample supply, 1-month silver lease rates typically sit around 0.3% to 0.5%. Nothing exciting, just a small return on an otherwise non-yielding asset. By January 2026, that rate had exploded to around 8%. Why would someone pay 8% annually just to borrow silver for a month? Because the physical market is short to a degree that is clearly abnormal. When financial institutions are willing to pay that kind of premium just to guarantee they can take delivery on time, you know the supply-demand dynamics are severely out of balance. Before we dive into why China is the key player here, if you're finding this investigation valuable, make sure to subscribe to Finance Deciphered. We're tracking the moves that the mainstream media is too afraid to touch. So to summarize what we've established so far, supply growth is constrained by the fact that most silver is a mining byproduct. Demand has been consistently outpacing supply for 6 consecutive years. Inventories have been drawn down to dangerously low levels, and lease rates are screaming that the physical market is under stress. That's the setup. Now, what makes this entire situation far more volatile is what's happening on the demand side, and that's where the story gets really uncomfortable for global markets. Silver isn't just sitting in vaults looking pretty. Unlike gold, which is primarily a monetary asset and store of value, silver has a dual identity. It's both a financial asset and one of the most essential industrial metals in the modern economy. And that industrial demand is not only huge, it's growing at a pace that's difficult to overstate. Here's the thing about silver that makes it irreplaceable. It's the best conductor of electricity and heat of any metal on the planet. Better than copper, better than gold, better than anything else we've discovered. This makes it absolutely critical for a whole range of technologies that define the 21st century. Solar panels alone consumed roughly 200 million ounces of silver in 2025. Electric vehicles, which are packed with electronic components and circuitry, are consuming increasing amounts. Data centers, which are multiplying to support artificial intelligence and cloud computing, require vast quantities of silver for their infrastructure. 5G networks, medical devices, defense systems, the list goes on. All of these industries are growing, and all of them need silver. Industrial demand hit approximately 665 to 680 million ounces in 2025, representing more than half of total global demand. And here's the uncomfortable reality. In many of these applications, there's no good substitute for silver. Engineers have tried to reduce silver content in solar panels for years because the metal is expensive, but there's a limit to how much you can reduce without sacrificing efficiency. When you're building a solar panel, you can't just swap out silver for copper and hope for the best. The physics doesn't work that way. Now, to make matters worse, this industrial demand is colliding with something entirely new and completely game-changing: export restrictions from China. Starting January 1st, 2026, China implemented new controls requiring government licenses for all silver exports. Only 44 companies have been authorized to export silver, and they must meet strict criteria including minimum annual production of about 80 tons. This might not sound that dramatic until you understand China's role in the global silver market. China accounts for roughly 13% of global mined silver, which by itself isn't huge, but China dominates 60% to 70% of global silver refining. That means even if silver is mined in Mexico or Peru, there's a very good chance it's being sent to China to be refined before it can be used in industrial applications. By putting these export controls in place, China is effectively saying to the rest of the world, you can no longer rely on Chinese refined silver to plug your supply deficits. This is the same playbook China used with rare earth elements, and we all know how that turned out. For reference, during the January to November 2025 period, China exported around 4,600 tons of silver, while importing only about 220 tons. They're a massive net exporter, and now that flow is being choked off, or at minimum made far more politically controlled, what's the immediate result? Physical tightness in markets outside China. London, which is the primary trading hub for physical silver in the West, has seen its inventories plummet. Unusual arbitrage opportunities have emerged as shortages in London, and Shanghai create price dislocations and volatility that, frankly, shouldn't exist in a well-supplied market. For industrial users in North America, Europe, and other parts of Asia, the message is brutally clear. You need to secure your own supply chains, and you need to do it fast. So now we have a situation where industrial demand is enormous and growing, supply is structurally constrained, inventories are at multi-year lows, and the largest refining hub in the world has just put up regulatory barriers. That alone would be enough to drive a serious price rally. But we're not done yet, because there's a completely separate source of demand that's just starting to emerge. And it's the one that has the potential to make this situation truly explosive. For 70 years, the rule was simple and ironclad. Central banks buy gold, not silver. It was a matter of institutional orthodoxy. Gold is the monetary metal, the ultimate reserve asset, the foundation of central bank credibility. Silver was for industrial users and retail investors, not serious monetary institutions. Between 2022 and 2025, global central banks bought more than 1,000 tons of gold per year. Silver? Essentially zero. In early 2026, that orthodoxy began to crack. Russia moved first. Under Western sanctions and financial isolation, the Russian central bank has been searching for assets that can withstand U.S. financial coercion. Gold was the obvious choice, and Russia has been accumulating it aggressively. But Russia already owns substantial gold reserves, and further massive purchases draw intense international scrutiny. Silver, by contrast, started being seen in a different light. It has hard industrial demand. meaning it can't be easily dismissed as just a speculative asset. It retains monetary characteristics: scarcity, divisibility, resistance to debasement. And perhaps most importantly from a geopolitical perspective, it's a lot less visible than gold. As part of Russia's draft federal budget for 2025 to 2027, the government allocated 51.5 billion rubles, roughly $535 to $538 million for precious metals purchases. And for the first time, that allocation explicitly included silver alongside gold, platinum, and palladium. Russia is the world's 8th largest silver producer at about 38.5 million ounces annually, so they have domestic production to leverage. This wasn't just a financial decision, it was strategic. Russia is signaling that silver has value as a reserve asset in a world where dollar-based settlement systems are increasingly weaponized. But Russia isn't alone. India made silver eligible as collateral for loans, setting a 10-to-1 ratio compared to gold. That might seem like a technical banking regulation, but it's actually a massive statement about how India's central bank views the relative value of silver. The current market ratio between gold and silver is around 50-to-1, meaning India's regulators believe silver is far more undervalued than current prices suggest. Saudi Arabia's central bank invested $40 million into silver ETFs. Now, to be clear, ETFs are not the same as taking physical delivery of 1,000-ounce bars, and institutions that understand markets tend to be skeptical of paper silver for good reason. But the significance isn't how they bought it. It's that they bought it at all. A central bank in Saudi Arabia, a country with effectively unlimited oil wealth, decided to allocate capital to silver. That doesn't happen by accident. There's also a quieter layer to this story that's harder to track through official channels. Some emerging market central banks appear to be engaging in what the industry calls shadow buying, acquiring silver via third-party entities, sovereign wealth funds, or non-transparent channels, rather than through formally announced reserve programs. The advantage is obvious. They avoid headlines and market-moving announcements while quietly building strategic stockpiles. Industry estimates suggest that from the second half of 2025 into early 2026, emerging market central banks may have acquired several 100 million ounces of silver through such routes. Now, why would they do this? Part of it is diversification away from dollar-denominated reserves, but there's another angle that's becoming increasingly important in discussions about de-dollarization, trade settlement. If you're a country trying to figure out how to settle international trade without using the US dollar, gold is an option, but it's very expensive. Not every nation can realistically settle large volumes of trade in gold. Silver, however, is much cheaper per unit and simultaneously has real industrial demand, which means it can't be fully virtualized or replaced by pure digital tokens. It has tangible utility, and that makes it more politically and economically palatable as a medium of exchange or settlement in bilateral trade agreements. Russia, India, and Saudi Arabia aren't the only ones taking silver seriously. The United States added silver to its list of critical minerals in 2025, although the government has yet to fully clarify what that means for tariffs or stockpiling. Australia named silver as one of just 5 priority metals in its 10-year critical mineral strategy. China's export restrictions, as we discussed, are explicitly framing silver as a strategic resource. 3 continents, same signal. Silver is being reclassified from industrial commodity to strategic asset, and that reclassification is happening at the sovereign level. What makes this trend so dangerous for the broader market is that central banks operate on entirely different time horizons and with entirely different objectives than private investors or industrial users. When a central bank decides to accumulate a physical asset, they don't care about short-term price fluctuations. They're not trading in and out based on technical analysis. They're building long-term strategic reserves, and they're perfectly willing to buy at higher and higher prices if it serves their geopolitical or monetary objectives. And unlike retail investors or even large hedge funds, central banks have functionally unlimited capital. If even a small fraction of the world's central banks decide they want meaningful silver reserves, the impact on a market that's already running structural deficits could be absolutely catastrophic for anyone who needs physical metal. So let's put all the pieces together and see what we're actually looking at. On the supply side, you have constrained production that can't respond quickly to price signals because silver is a byproduct. You have inventories drawn down to dangerously low levels. You have China choking off refining and export capacity. On the demand side, you have industrial consumption that's non-negotiable and growing. You have central banks starting to accumulate for strategic and monetary reasons. And you have investors, both institutional and retail, waking up to the fact that this market is fundamentally broken. This is what's known in the industry as a physical squeeze. It's not a speculative bubble driven by mania and leverage, although there's certainly speculation happening. It's something very different from gold. Gold is the asset of central banks and billionaires. Silver is the asset that's actually accessible. At current prices, you can still buy physical silver in quantities that make sense for normal people trying to protect purchasing power. But that window may not stay open forever. If central banks are quietly building strategic reserves and industrial users are scrambling to secure supply, the retail market is going to get squeezed out. The other thing to understand is that this isn't just about investment. Silver is a cornerstone of the energy transition, of electrification, of the technologies that governments around the world have committed to deploying at scale over the next decade. If the physical market remains this tight, it doesn't just affect silver prices. It has knock-on effects on the entire green energy supply chain, on electronics manufacturing, on defense production. Governments are not going to allow critical industries to be held hostage by a lack of silver, which means we could very well see strategic stockpiling programs, export bans from other producing countries following China's lead, or even direct government intervention in markets. The bottom line is this: the silver market is undergoing a transformation that hasn't been seen since the 1970s. For decades, silver was dismissed as a side note, an afterthought, a volatile commodity that serious investors didn't need to worry about. That era is over. Silver is reasserting itself as a monetary metal and a strategic resource simultaneously. The institutions that understand this are acting quietly and decisively. The question for everyone else is whether they're paying attention. Now, obviously there are risks to this thesis. Industrial demand could slow if the global economy weakens, or if companies find ways to reduce silver intensity in their products. Some analysts are expecting silver demand to moderate in 2026 compared to the explosive growth we saw in 2025. Investment flows could reverse if macro conditions change. For instance, if interest rates rise significantly and make holding a non-yielding asset like silver less attractive. And it's always possible that new supply sources come online, or that recycling rates improve enough to ease some of the pressure. But here's the thing. Even accounting for those risks, the fundamental equation hasn't changed. The world needs more silver than it's producing, and that gap isn't closing. Central banks are treating silver as a strategic asset for the first time in living memory. Industrial users are locked into technologies that require silver and can't easily substitute away from it. And the financial markets are slowly waking up to the fact that decades of treating silver as an afterthought may have created one of the most compelling supply-demand imbalances in the entire commodity space. For those of us watching from the outside, the lesson is the same one we've seen play out in energy markets, in rare earths, in semiconductors. When governments decide something is strategic, the rules change. Markets that were once driven by purely economic logic become arenas of geopolitical competition. And in those environments, the people who see the shift coming and position themselves accordingly tend to do quite well. The people who don't tend to wish they had. This is Finance Deciphered, and we're here to help you navigate the complexities of the global financial landscape. Until next time, be smart, be strategic, and be prepared.